We're trying to teach everybody how to fish. Incredible company. That's why I like software businesses. That's pretty solid. I want them buying back their shares aggressively. Hey, I think this is a great company. Microsoft stock, a darling of Wall Street. It's been a big company. It had a big surge. I think it was that during the financial crisis, it got in the low double digits. Incredible company. So 2 things. If you're new to the channel, there's gonna be a lot of things we talk about that might sound confusing. Just be calm. It's okay. It's about repetition. Watch our other videos. You will get the hang of it. 2, if you're looking for me to just hand you a stock to buy, we're not the channel for you. What I'm trying to get people to understand here is we're trying to teach everybody how to fish. We want people to be able to sit on their own and be able to independently decide what companies are good or not. So let's dig into Microsoft. So let's pull up our software. And again, if you have the software, it's a great thing to just follow along on. I mean, look at this chart. And not that I care much about charts, but look at this, guys. Microsoft back in 2000 hit $50. And I think down here was a low of like $11 or something crazy like that. It wasn't worth $50 here. It was worth way more than 11 here. That's the point. That was a bad time in the markets. Everybody gave up on Microsoft. Now, in the last year, little over about 14 months, the high is 350 on Microsoft and the low is 213. And today it's currently at 228. So it's a little bit off of its low. Okay. Some key attributes of Microsoft. Not a lot of debt. This is their market cap. This is their enterprise value. The difference tends to be the debt level. I won't get into the math of it, but that's essentially the debt level. So there's not a lot of debt in this company, which we love because debt hurts companies same way it hurts your individual bank account, your individual finances. A small dividend, but because of how expensive how high the micro cap is, the dividend is a lot, 18.5 billion, but easily supported with their free cash flow last year of 63 billion and the 5-year average of 48 billion. So I'm not worried about this dividend going away. My guess is over time, as the company gets larger and larger, they will increase their dividend. And if the company gets cheap enough, they just start buying back more shares. So look at this, gross profit margin of 68%. What does that mean? Every extra dollar they sell generates about 68 cents in profit they can use then to go pay overhead and taxes. And the bottom line, after all overhead and taxes, is about a third, about 33%. So let's check out the 8 pillars. All right, what we love to see here, guys. 8 pillars. The 2 X's are the price to free cash flow and the PE ratio over the last 5 years. Very consistent, 34.76, 34.55. Everything else is wonderful. Look at this ROIC, 25% return on invested capital. What does that mean? They do a great job of generating a good return on the money that's invested in the business. If 2 companies side by side, one makes 10% and one makes 25%, in order to generate more and more profit, this company has to invest a lot less money. That's why you want this. This is how you get companies that can really compound on itself. That's the kind of things you should be looking for. High return on invested capital businesses. Very slight shares outstanding decrease. You know, I don't want companies that have such high PEs and free cash flow buying back a lot of shares, because even though they're buying back their own shares, they're still investing in something. It doesn't matter, it's their own shares. I want them buying back their shares aggressively if, let's say, this 5-year PE was 10. And you might be surprised that might happen at some point because fundamentals will get better. Stock price may fall because of a shift in the market or whatever. But overall, guys, Microsoft's a very, very solid business. Only 2 years of debt on their 5-year average free cash flow. So they continue their 5-year average. They could pay off their debt in 2 years of it. That's pretty awesome. So overall, guys, again, if you're new, this is a lot of information to throw at you. But I like to look at companies based on their fundamentals and not based on what the market sits there and decides because some 19-year-old college kid goes, hey, I think this is a great company. No. At the end of the day, all investments are the present value of all future cash flow. And if you can pay a cheap price for that cash flow, you're probably going to do very well. When I look at a company like Microsoft, first question I ask is, do I think it'll be around for the foreseeable future? Absolutely. Second question, do I think they're going to make more money and more profit and revenue in that foreseeable future than they do today? I would guess so. Here's why. The world is not fully developed. No, there's still half the world that doesn't have computers on a regular basis. That's a whole new market for Microsoft to go attack. They can really drive that revenue and profit up. And the third question I ask, can I pay a reasonable price today based on those assumptions about the future that give me an ample return on my money? And that's what we're here to answer. All right. So we're going to use our stock analyzer tool to decide that. So let's look at analyst estimates first. Now, guys, the company's expected to make $9.74 this year based on the average 48 analysts here. And in 2027, $18.30. So almost double. That's pretty solid. I mean, look at this growth rate. That's pretty solid growth rate. Now, keep in mind, these analysts can be wrong, and a lot of times they are wrong. But in a combination with growing revenue and profit and decreasing shares outstanding, buying back shares, they can really drive this earnings per share up. We want to see that EPS growth because it makes your shares more and more valuable, right? Because the PE is going to be applied to this share. And let's say, for example, in 2027, they actually made $18.30. And you sat there and said, hey, I'm going to apply a 15 PE to that. What does that make your company worth? $270 a share. Now, the question becomes, what's a reasonable assumption about the future? So let's go look at the revenue. Now, the revenue growth is not going to be as high. Remember, with such a high gross margin, remember that gross margin was 68%. With such a high gross margin, they don't have to generate a lot of new revenue in order to really increase their profit. That's why I like software businesses. They can really, every dollar they bring in, there's 68 cents more they can use that they get to themselves, but they've already paid their overhead. They're already paying that stuff. So that's 68 extra cents for every dollar they can put towards the earnings per share. That's why even with revenue growth being low, it's okay. It's quite all right. All right, so let's go to that stock analyzer tool. Now, I'm gonna do something different. When Mo's here usually, and he's down in Mexico right now, one of us will do a 10-year analysis and the other one will do a 20-year analysis. It's very important. This part of our software is extremely, extremely popular. We have thousands of users here, but this software was used, I think the final number is about 1.3 million times in 2022. When Tim came to my office and said, hey, how many times do you think it was used last year? I said, I don't know, 300,000. And he was like, no, it was 1.2 to 1.3 million times. I was like, oh my gosh. So it's a very important aspect, and it's extremely important that you understand the process and the methods behind it. So rewind this part if you get confused. I'm going to try to explain my thought process, but this is the art of investing because I'm going to make assumptions on revenue growth, profit margin, free cash flow margin, PE at the end of my analysis, and price of free cash flow. And then what return do I want? Those are the main things we have to understand here. Now remember, the stock analyzer tool does not factor in the balance sheet at all. Now, luckily, Microsoft seems to have a pretty good balance sheet without a lot of debt and a lot of cash on hand. So that's a good thing. Actually, let's go check that out real quick. Balance sheet. They have $160 billion in cash and cash equivalents and $186 billion in all liabilities. So they can almost pay off all their debt with a stroke of a check. That's pretty awesome. All right, so I'm going to do a 10-year analysis here. Revenue growth. I'm going to be very conservative and then accelerate from there. 4, 7, and 10% revenue growth. Profit margin. Let's see here. I think their profit margin should stay pretty decent. So 28, 31, and 34. Free cash flow margin, I'm going to do 20, 28, 30, and 32. Now, PE and price of free cash flow. They're currently 24 and 26. If you remember on our 8 pillars, those were 5-year numbers on the PE and price of free cash flow. So it has a lot lower numbers in its history as it goes higher. So that's why the 5-year number is lower than the 1-year numbers. This is the PE I'd expect at the end of 10 years. Now, they're a high return on invested capital business, so I should be willing to pay more for them, but they're not going to grow very fast, but it's a huge moat. So the average for stocks is about 15 over long periods of time. So I'm going to start with 15 and then go 16 and a half and 18, because Warren Buffett and Charlie Munger always say that the higher the return on invested capital, it shows a moat, it shows a durable business, you should be willing to pay more. And I agree with them. There are 2 businesses exactly the same. One's making 20% ROIC, one's 10. I'd rather pay more money for the 20% ROIC. Same with growth. 2 companies exactly the same. One's going to grow 20% a year. One's going to grow 3% a year. Which one would you pay more for? Of course, 20%. And that's part of the art of investing. That's why we're here teaching how to fish, because we don't know the exact right numbers for everything. But when it comes to Microsoft, this is a huge business. You're probably not going to buy this company and make 100 times your money in the next 30 years. It's going to take a long time, but you'll probably collect good dividends. They're going to buy back shares as it becomes less and less sexy, and they're going to be able to do things with the capital that'll make your investment better and better. So you're probably going to pay more for this company than a smaller company in terms of its security. Microsoft is probably not going away. So factor it in there. Now, for our last metric, desired annual return. Guys, this is your basic margin of safety. We hear that all the time from Buffett and Munger. Your margin of safety is, hey, I could be wrong. There's things I'm missing. I want to buy it when it's below that price. And you can get 9 or 10% by investing in a long-term ETF, right? Like VOO or SPY. So in order to buy an individual stock, my opinion is you should have a higher desired return than 9 or 10%. I usually do. I start at 12. Now, where do I go from there? I'll probably do 13.5 and 15 because these are very high assumptions here. They have to really do well for the next 10 years and basically match everything they've done. So that's less likely to happen. So I want a higher margin of safety because the more return I want, the less price I have to pay. It gives me more margin of safety. The stock's currently at 228. I'm hitting the analyze button. Okay. It's on my watch list at 160. I have a low price of 106, a high price of 180 basically, and somewhere in the middle of 130 to 140. Now, why is it on my watch list at 160? That's not where I'm going to buy it at. I'm going to start selling puts at lower prices there, okay? That's the big key. And you think that the stock's not going to get there? Guys, just remember, just 14 months ago it was at 350, and now it's at 228 after hitting a low of 213. So again, guys, if you like this, please subscribe. I understand it can feel confusing, but if you're the kind of person who wants to learn how to do things on your own, especially with investing, we're the channel for you. Thank you very much for your time.